Welcome, my name is David Healy. With me today is Brian Berry and David Appleby. This is the 2024 Appleby Healy Client Care Workshop. Today we're going to talk about taxes and what type of taxes your estate may run into when you die. Generally speaking, when somebody dies, there's three things that are going to happen in any situation. We're going to transfer assets, we're going to take care of some bills, and somebody is probably going to deal with the IRS. So today we're going to talk about the last aspect of that, what type of issues may come up with the IRS, and what type of taxes we may encounter. Brian, you want to talk to us about just kind of the general list of types of taxes we run into?
Broadly speaking, and of course we'll get into all of these categories in more detail, but these are the things that routinely come up and that clients ask us about. I think probably top of the list in their interest, for whatever reason, is what is commonly called a death tax, the estate tax. People are understandably concerned about that, and I think relieved when we tell them that unless you are one of our rare clients who has a little over $13 million this year, it's adjusted for inflation every year, and it went over $13 million for 2024 per individual, so a married couple doubles that. That's an issue that for some folks it comes into play, and I think for most folks we talk to is at least something that they ask us about. Capital gains tax is another thing that we talk about. This is the increase, a tax that's owed on the increase in value on an asset, whether it's real estate or some other asset, the difference in value between the time you purchase it, the basis, and the value when you pass away. That is there tax due on that or not, that capital gains tax? Is there what we call a step up in basis on that capital, that asset or not? Can depend on whether you've got a revocable or irrevocable trust. We talk about these issues. Of course, the IRS is going to get one more 1040 out of you. They get one more bite on the individual basis based on the partial year from when you die. Your estate also may owe taxes. That would be a 1041 tax return. Sometimes that's due and sometimes it's not. Sometimes it's a very short postcard type return and sometimes it's longer. Real estate taxes, if your estate owes real estate, that can be an issue with the collector as well. Gift taxes is something else we'll talk about. This is something that's always adjusted for inflation. It goes to $18,000 this year and applies to gifts that you make during your lifetime. And then taxes on qualified retirement accounts. These are your tax deferred assets. Nothing's tax-free, but you can defer those taxes with tax-free dollars in your 401ks, your traditional IRAs, 403bs, assets of that nature.
Okay, so there's a lot of different types of taxes that we think about. David, tell us about the estate tax. That's kind of the one people ask the most about, right?
It is. I think this always comes up. Everybody's worried about it. When we talk about your goals for your estate plan, it's one of the things that we try to talk about and avoid or at least minimize. Just in an overall sense, there are two types of, quote, death taxes, end quote, in this country. One is the federal and state estate tax, and the other is inheritance tax. As to the federal and state estate tax, it's something we've had well over 100 years. It was instituted in 1916. At that time, the exemption from that was $50,000. Now, $50,000 through inflation, Brian mentioned this figure of $13,610,000, but that's an inflation-adjusted number. So in 1916, when this was instituted and the exemption was only $50,000, only 71 returns were filed nationwide. So even in the beginning, this affected only the people that we'd consider quite wealthy. In 1917, Missouri then enacted something called an inheritance tax. That was later repealed in 1980. The majority of states now have repealed that, although some still do have that. The majority of our clients, of course, in Missouri. So as to the Missouri law, what that means is there is no such thing as inheritance tax. So the bottom line here, before I finish, but I'll skip to the punchline, for most families that we work with, when somebody dies, there is no death tax due because they're under the exemption, number one, and number two, we don't have the inheritance tax. So as I say, realistically, very few of our clients have to deal with the idea. The concept, though, because it's continued to go up and up and up as far as Congress is concerned, and they've made this inflationary jump, it's because they don't want the average taxpayer, the average household, or even upper middle class households to be affected by this. And primarily, over the last 30 to 40 years, the idea has been that we don't want people to have to sell their family business, or particularly their family farm, in order to get the money to pay the death tax on it. So it's continued to go up. As an example, in 2021, which are the latest figures that we really have, approximately 3.4 million Americans died. Of that number, only about 8 out of every 10,000. So it's less than 0.1% of the people that died actually triggered that tax. So that's why we tell people, again, pretty comfortably, most people are not going to have to deal with that. If you do have more than that, and I should add, that's a per person exemption. So we're talking over $27 million spread over the death of both of you. Many of you will remember when we did your trust, we included language so that we could double that number over the death of both of you, okay, which now, as I say, would be over $27 million. If anything's over that, if you did have 28 million on that final million, the initial tax bracket on that's about 40%. By the time, as I recall, you get to a million over, so anything a million over the exemption, you're already up to 50%. So you can see that there's significant things, and anybody that we've talked to who now exceeds these limitations probably needs to come back and see us because that tax is high and we need to take some measures to get away from that. So again, in summary, typically most of our clients don't have to worry about it. If you are worried about it, then of course you need to let us know and we can talk about that.
And David, let's talk about that concept you just mentioned for a second there, that deceased spouse's unused exemption. That's something we typically tell clients is one of the reasons we want to see the surviving spouse fairly shortly after the first spouse dies. That's a pretty small window to file that, correct?
Yes, 9 months.
So if you miss that 9-month window, there are some things you can do, but the penalties become onerous at a certain point. So it's really important to come in and see us. If you're anywhere near that limit, there might be some tax advantages for taking care of that. But the biggest thing that we like to tell clients is we don't expect you to figure that out, but we need to know.
I think too, a lot of people wonder, well, is having this trust and having this marital deduction language, we call it, in there, most people won't need it, but we don't know who's going to win the lottery, and we don't know what you're going to inherit, and we don't know what inflation's going to do, and we don't know if Congress is going to reduce the exemption. So if any of those things happen and you're over, so I was talking about a $27 million exemption. If you own the same property, not in your trust with marital deduction language, and you died with it as husband and wife, that's not a problem. When the first of you dies, we use the exemption, but because it was held under Missouri property law as tenants by the entirety, now the survivor has the 27 million. So now when the second of you dies, you'd be 13 million over at that 15% bracket. We'd be talking about $6.5 million worth of taxes to your children. So that's an important reason to include that language.
And in fact, David, if not only can the government change these exemptions downward, it's baked into the law as it exists right now, that this $27 million joint exemption is set to sunset as it is right now, which makes it, of course, an election issue that we continue to monitor, because there are parties who are going to want to maintain that sunset clause and others who may very well want to extend it, and so that's something we monitor.
That's right. In 2025, this is all set to expire. It's going to roll back to $5 million per individual, adjusted for inflation. And of course, that sunset could be expanded out. But it's a moving target. And what David just said about we don't know when you're going to die and what the exemption amount is going to be and how much money you're going to have when you die, this is just another reason to stay in touch with your lawyers and stay in touch with us just regarding general planning, but also the estate tax consequences. Let's move over to income tax. So everybody's favorite subject, income taxes is something that we all deal with, and regrettably have to inform you that your estate will deal with income taxes after you die. The IRS is not done with you just because you died. That does not get you out of income taxes. So the first layer of income taxes is going to be on the money that you earned while in the year that you died. So if you died in September and you were out working up until the point of death, you do have to report that on your 1040. It'll be by April the 15th of the following year. Your estate representative, your trustee or personal representative, somebody's going to need to file a final 1040. If there's any refund owed off of that, that would come back to your estate. Likewise, if there's any tax owed, your estate's going to pay that. Then there's also potentially income that your estate earns, right? This would be assets that you owned at death that are producing income. How's that handled, Brian?
That's right. Not only can individuals earn money and businesses earn money, but estates do as well. So for an individual, it's a 1040 return. For an estate that earns income, that's a 1041 tax return. There are some CPAs that are familiar with these, and frankly, very many who are not. We can always put you in contact with those who can, but it's a very specialized type return for estates that earn income. Sometimes that's a lengthier return, and sometimes we can do it just as basically a postcard type return. But the two things that trigger the need for an estate to file that are, number one, the sale of real estate. That's always going to trigger the need to file at least a basic 1041 return, or if an asset of the estate earns more than $600. These are the two things that are going to trigger the need to talk to somebody who is familiar with these types of returns and deal with that issue then. This became more of an issue when the IRS started requiring title companies to issue 1099s to estates when real estate is sold out of an estate. So we started to see it more then. Your beneficiaries, for reasons associated with this, are going to get K-1s based on income that they receive out of the estate. But this is an issue that crops up for some estates and some not. But again, we would encourage you to let us know whether or not your estate is earning income, and we can put you in touch with CPAs or other tax professionals who can deal with it.
Yeah, Brian, you make a good point about making sure we have an experienced CPA handle the complex 1041s. Some estates, when we sell real estate, that's a fairly simple 1041. But I was involved in an estate where the family really wanted to use their family CPA, who is a fine CPA, but potentially out of their depth with a complex 1041. I did ask to review it, and what we wound up doing in that estate actually was taking that to a more experienced CPA who, instead of paying taxes in, the estate actually received a $45,000 refund, which was more in line with what I was anticipating that estate should have had occur there. And it's nothing against the CPA that did the first draft of that, other than they were potentially a little out of their element just trying to help. But it is important. We have complex estates, and that's going to be an estate that might have investment accounts, charitable distributions, just a way to offset income in respect to the decedent, things of that nature that some CPAs don't see every day. It's really important that we have a CPA involved that's very knowledgeable in those areas, and that we maximize the efficiency of that return for the beneficiaries.
And it's also worth mentioning in this context that not only can estates earn money like anybody else can, or like a business can, it can also have losses as well. And we've got ways that we can deal with that, and perhaps work it so that the losses of the business can be passed down as a loss that can be reported by the beneficiaries. So that's something else that we can talk about as well.
Absolutely. David, let's move to capital gains.
Okay. Before we do that, let me go back and talk about income taxes due on that final 1040 return. And not so much specifically that, but the IRS is probably not going to be the only creditor in many cases. Maybe there's a last hospital bill, there's a funeral bill, there's other expenses that might be out there. There may remain a home mortgage. And I say this because a lot of times when I meet with the family after somebody has passed, those family members seem absolutely shocked that they've got to pay your bills, whoever the trustee or the personal representative is. That somehow there seems to be a concept out there that you can die to get out of paying your bills, and that's not accurate. And so I ask you to think about that, and if there's going to be a remaining home mortgage or something, you might talk to their beneficiaries about that. That way when you pass, they're not mad at us for being the bearer of bad news. Oh no, you've got to pay the hospital bill, and you've got to pay the funeral bill, and you've got to pay that mortgage. I'm not exactly sure why that's a misunderstanding, but it's more frequent than perhaps you might think that would happen. On to capital gains taxes. It's not uncommon for people, and I'm going to use your home as an example. You have an asset and it appreciates during your lifetime. So if you paid $100,000 for a home, 3% compounded over 20 years is going to be about $200,000. And Brian mentioned the step-up basis. So depending on how you transfer that, but certainly we're talking about those of you that have a trust and your home's in the trust, you're going to get that step-up basis to value as of date of death, which effectively then wipes out all the income, even at capital gains rates, on that $100,000 gain. This is one of the reasons you may recall that we tell you we probably won't even do it if you ask us to. Just deed the family farm over to the kids, because when you do that, they get the low basis or the carryover basis, sometimes called the depreciated basis. And now we'd have to pay incomes. I say your heirs, your beneficiaries have to pay income tax on that $100,000 gain. So that's why we put your real estate and your major assets over in the trust, so we get that step-up basis to value as of date of death. So if you sell the property from the trust or after you've inherited the property, then you only have to pay income tax at the capital gains rates on that inflationary gain since death. So if you hold it another couple of years, now my hypothetical $200,000 piece of land is worth $220,000, then you only pay income tax on the $20,000. So that's kind of how that works. Some assets are easy to track. Those things are recorded, stocks, bonds, and your tax preparer is going to be able to help you with that. Some assets are a little bit harder to track, and that has to do with the real estate. My experience is that most people have no idea how much their parents paid for the real estate, for instance, they're going to inherit, which is why we ask the parents at the time that we are preparing your plan, how much did you pay for this? So even though there's no official record, at least in our file, we've got a number that you believe is accurate. If the property sells pretty quickly, then I think the IRS is pretty open to accepting that number, that was the fair market value as of date of death. But if you're going to maintain that property for any length of time, then you really need to get at least what I'd call a real estate opinion letter, broker's opinion. I don't think you necessarily have to go out and spend several $1,000s on an MAI appraisal on that, but we need something in the file, and you need, so we could prove the basis when you get ready to sell it. So if you have it in the trust and the trust winds up paying that tax, it starts out at 20% as soon as the estate is over the $14,451 level. And you don't have to remember that number, but just understand that you hit that maximum capital gains bracket for federal and state pretty quickly. And the way to manage that for you is to distribute the capital gains directly to the beneficiaries and then let the beneficiaries pay. The advantage to that is that most of our clients, okay, in the year of their death are probably going to be below those capital gains rates individually. So if you're in a 15% bracket, then, and that's for people that have the retirement and their Social Security, but if you're in a 15% bracket, then obviously we want to get it into your hands and let you pay the tax rather than pay the higher capital gains rate.
Okay. So the other thing that we probably get, I'm going to say the second most questions about after the estate tax is, what do I do with my retirement account? And unfortunately, that answer is potentially harder to develop than it ever has been at any point in my career, and probably in David's career or Brian's. It's very complicated now. It used to be very straightforward, but what happened was in 2019, a new law was passed. It was called the Secure Act, and S-E-C-U-R-E. The Secure Act basically just upended the entire taxation process for retirement accounts when you die. And when I talk about retirement account taxation, I'm talking about those tax-deferred installments you've made through payroll for all those years to a 401k or to an individual retirement account, things that are deemed by the IRS to be a qualified retirement account. So when you die, all of those tax deferred payments, now the IRS wants their money. They want your tax money. So the law was passed in 2019. It was amended in 2022 with a short 485-page amendment. And there is promise of another amendment this summer. There's bipartisan support to amend the Secure Act yet again. They're going to call this one Secure 3.0, and more changes are on the way. They are telling us clarifications. From practice, I will tell you changes. So more changes are on the way. So the biggest things to probably know about your retirement account. First of all, it has one of two paths it can start down. One will be directly to your beneficiaries. The other is directly to your trust or some variation of your trust. If it goes directly to the beneficiaries, they're going to have 120 months to pay old income tax due on that account. Whether or not they take required minimum distributions during that 120-month period depends on a number of factors, including whether or not you had started taking required minimum distributions, whether or not they're an owner, or whether or not they're a beneficiary. There are several factors to take into account, but the end story will be at the end of 120 months, all the taxes have to be paid. If it goes over onto the trust, and there's reasons that we want to have, in some cases, the trust be the beneficiary. When people ask that question, should my trust be named as the beneficiary of my retirement account, my answer is always the same. It depends. It depends a whole lot on your personal situation. It depends on if you're married. Tell me about the kids. Every family is going to have a different answer to this question. If it goes into the trust, the first thing we have to calculate is, well, when do we pay the taxes? And when we pay the taxes is simply a calculation of, and how much are the taxes, is going to be a calculation of how much is in the account and what is the distribution period. That second part, what is the distribution period, has 12 different answers. So there's 12 different distribution periods depending on your personal situation. You can see where it's getting complex here. And we don't take it lightly, the fact that financial advisors and CPAs are now calling and emailing us asking for what we think the answer is. It's not clear like it used to be. Now everybody's asking each other, what's the answer here? So what's in the trust depends if it's into the holding trust or is it directed to a sub-trust. Tell me about the age of the beneficiaries. Tell me, is anybody chronically ill or disabled? A myriad of factors go into determining at what rate the life expectancy is going to be. But generally speaking, it comes out to one of three answers. It's either going to be the life expectancy of the oldest beneficiary or a qualified chronologically ill beneficiary, or it's going to be 120 months, or it's going to be 60 months. So that's kind of the three categories everything eventually will fall into. The 60-month one is one we, of course, want to avoid. Fairly easy to do, but there is a trap here for people who name charities as a primary beneficiary of their estate plan. That's because typically the retirement account is used to satisfy those type of bequests. That's just something that we always have to talk to clients about, is if a charity is named, you're probably going to be in the 60-month area here. So then we need to look at everything else. Sometimes it makes more sense to kind of peel that off and have that go outside of the trust so that the remaining beneficiaries can take advantage of the 120-month period to pay the taxes. And again, this all just depends on your personal situation, size of the accounts, how many beneficiaries. Everything's going to be different for everybody we talk to. Generally speaking, and I don't know, the answer to that sounds like it depends and it's complicated, and that's really the best answer I can give you. Other things to be aware of, however, are if you turned 72 last year, the required minimum distributions start this year for you. Next year, it's going to move up to 73. So we're making this graduated transfer or move up in age to required minimum distributions. If you need to take an early withdrawal, so everybody's probably familiar with the 10% penalty for an early withdrawal. And I can tell you in years past, that was pretty much black and white. With the Secure Act, of course, we have more layers. There are 22 exceptions to the 10% penalty. And I'm not going to go through all those 22 exceptions. This being an hour-and-a-half video. And again, it's complicated. And a little bit of good news. At the beginning of this year, Roth accounts, they've got rid of the RMD structure, which makes a ton of sense and never made any sense to start with. There are no required minimum distributions. And really, to sum that whole section up, It kind of goes with what we talked about with David with the estate tax and capital gains. This is absolutely one of those areas where we need to have frequent contact with our clients. If you have a really large retirement account, that can vary over time, whether it's going to the trust, whether it's going to the beneficiaries. For us to perfectly plan this, I need to know how much money you're going to have in that account when you die, and I need to know what the tax rules are going to be in the year that you die. You will not be able to answer either one of those questions, obviously, which means that we can't just set it and forget it. You need to come in and consult with us on a fairly regular basis about the status of your retirement accounts. So that wraps up your retirement account planning, which is pretty complicated. Brian, let's talk about something that's a little bit more straightforward and hasn't changed quite so much over the years.
Not nearly so much. This is the area of gift taxes. These are the gifts that parents give to their kids or anybody else, I suppose. It's been going on for a very long time, but there is a tax consideration that some people don't think about. That is the gift tax exemption. You can give up to, this year it goes from $17,000 to $18,000 in gifting without the need for the donor to file a 709 return with the IRS. So that's something that always needs to be considered. If you are one of the rare clients who has an estate that's in that death tax, estate tax realm, the $27 million air, that if you breathe that kind of air, then it is an offset to that exemption, anything that you give over and above that $18,000. So that's something that we can discuss as well.
You can't give it away to get out of taxes.
No.
And David, you want to throw something in about basis here too.
Yeah, and there's another disadvantage to these sorts of gifts. There's all reasons to do it. But remember, it's all your gifts. So if you give $1,000 to all 10 grandkids, you've now used 10,000 of that. But aside from that, just to throw in the multiplier here, but a couple, husband and wife, can give one of their children then $36,000 a year. I mention this because this can affect how you title the property and what you give away. I think where I encounter this most is when people call me and they want to give 5 acres to one of the grandkids to build their house on. And my first question is, okay, what is the value of that property? So it may be, if you think 2 people to 2 people, husband and wife, that'd be $72,000. It may be we need to add the spouse's name on that title initially so that we can actually go up to the $72,000 based on what that 5 acres is worth. So there's that issue. The other issue is when you're giving it away, you want to think about these basis rules we've been talking about, because a gift during a lifetime has that lower carryover basis on it. So if the property's worth $18,000, that's fine. But if you only paid $5,000 for it, you just passed that lower carryover basis. So if they change their mind, don't want to build their home on it and sell the property, they're going to have to pay the income tax on the difference between what they sold it for and what you paid for it. So there's a couple of potential adverse tax consequences. Now, if your kids go ahead and build a house and they live there 2 out of 5 years before they sell it, now we got past that, but we don't know what people are going to do. So again, it's a good idea, if you have a question, be sure and include your CPA in these conversations about both the gift taxes and also taxes on retirement accounts. More and more important than ever that we're talking with your financial planners and your accountants.
Okay, good point about the gift taxes, David. Let's talk about real estate taxes. So that is something that we threw in. Is really ironic. I had put this into the outline for this discussion because it's something I always talk to people about when they come in to administer an estate, and I tell them, don't forget that we have to pay real estate taxes on this real estate. So as an example, we have just a regular house, 3-bedroom, 2-bath. Let's say it's worth $250,000. But mom or dad has been in a facility for 2 or 3 years. Nobody's really kept up with the house. And nobody's even checked to see if real estate taxes have been paid. That's really important here, because what happens if you don't pay the real estate taxes? The property goes up for sale on the courthouse steps. And ironically, yesterday evening, a realtor called me at home, slightly panicked, closing on Friday. they just found out that nobody had paid the estate, nobody had paid the real estate taxes for 4 years. A year and a half ago, it was still on the courthouse steps. The collector's deed has already been issued about 6 or 8 months ago. The estate is essentially insolvent. It's only an asset they had was this piece of real estate. And I can only hope, I guess from a practical or professional standpoint here, that there was no attorney involved, because that's clearly a malpractice area. But it just goes on to a point here of there's lots of types of taxes. Some of them are not front of mind, and it's part of the reason that people engage attorneys to help them with this process, because we've seen these bad things happen. We don't want to see bad things happen to our clients' estates. But somebody has to pay the real estate taxes. Sometimes that even turns out to be a family member loans the money to the estate to pay the real estate taxes. Sometimes we might cognitively let them go for 1 year with the idea we're going to get the estate wrapped up the next year and we'll pay them at closing. But we're never going to let it go to a tax sale. So we have to stay on top of the real estate taxes. David, other things that we're going to talk about these workshops, that kind of comes to a conclusion of the tax side of this. At these workshops, there's a couple of things that we're going to talk about as well. One of them is things that we talk about at every workshop, and that's funding your trust, right?
Yes. And you know, this is something I think we talk about almost every year. Every time you come to see us, the initial conference, when we're signing your documents, when you come back to review or amend your documents, you call us on the phone about something, we go over this time and time and time again. So having a trust is great, but it doesn't work unless you put your property into the trust. Now, you may remember that you have what's called a pour-over or transfer will. Some states call it a spillover will. It doesn't matter what you call it, but that's the safety net, if you will. So if you have assets that are not in the trust, okay, then those assets would have to go to probate, and then the probate judge would order those transferred over to the trust. So to avoid that probate proceeding, you've got to continually look at your assets and be sure things are in there. And they all pretty much fall under a category. Well, there's 2 categories. Number one, not picking on you listening to this, it's just human nature, we forget things. So if you don't take care of it and you just forget it, then it's going to be in your estate when you get done. So we write you a letter, and it's included in your folder when you get your estate plan, and it says, we recommend you do this, 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 and this to be sure you get everything in there. Some people just forget to do it. But mostly, I find that it's after acquired property. Somebody dies and leaves you something, and you forget to transfer it. Or worse yet, you survived to be the beneficiary, but you died before the distribution. You were so excited about that new car that you forgot to title it in the manner that we suggested. You got so mad at the bank when you marched across the street with all your money, you forgot in your anger to tell the new bank. So you have to continually do this. This funding issue is perpetual. It never ends as you gain more property, you transfer property. So just be sure that you have your assets in the trust. If you need help, obviously you can call us. All of you in the CCP are not going to pay us for that phone call and for the advice. So simply call us and ask us what you need to do in terms of funding if that's an issue, if you find something not in there.
That's fantastic. We talk about this a lot for a reason. For those of you who signed estate plans with me, you know it's the last thing I talk to people about is, I'm sure probably Brian and David as well, but the last thing I talk to everybody about is we spend a whole lot of time and a whole lot of money for nothing if we don't get assets transferred to this trust. And quite frankly, it's a source of professional pride. I don't want to sit down with your trustee and talk about probate. We shouldn't have to. So if you have questions about that, please give us a call. We want to help. We want to make sure it works. We don't want to probate any part of your estate. We want it all to flow through the trust as it was designed to do. Okay, so another thing that we're going to talk about these workshops, it's a brand new law, and it's been around for quite a while. It has kind of slowly been making its way into being officially enacted. That happened in January of this year. That's the Corporate Transparency Act, known as the CTA. Brian, what can you tell us about the CTA?
As in most cases, when Congress passes a law, it can begin with a very laudable goal, in this case, fighting money laundering and the tentacles that reach out from that, terrorism and things that I think everyone can agree they want to fight. But there's the mission creep that comes with that a military man like David would understand, and that is it has grabbed up anybody who has any beneficial interest in a business entity. In other words, if you are a member of an LLC, if you have stock in a corporation, if you run one of these businesses, then you need to pay attention to this law because it comes with reporting requirements as of January 1. And if you don't follow this law, if you ignore it or you improperly follow it, then it comes with a potentially very hefty fine of $500 a day. Federal prison time can be involved in it. And this is, you avoid that by filing certain private information about you that we would like to all of us keep private, but now we're reporting that to the federal government, specifically FinCEN, which is a division of the Department of Treasury. So that's something that if you have any interest whatsoever in an LLC, corporation, partnership, or any other business entity, please call and talk to us because life changed significantly after January 1.
And Brian, the penalties for failure to comply are pretty stiff, correct?
Oh, they are. Like I was saying, it's $500 a day. If you do not comply with this, if you ignore the law or you don't properly follow it, $500 a day or federal, potentially criminal sanctions up to 2 years in prison.
Wow, okay.
And I don't think in my career that I've ever had something where I felt like I had to scare our clients. This is really the first law that's ever been passed during all my years of practice where I want to scare you. This is a big deal. And I think a lot of people are going to not realize that we're doing our best to tell everybody in any number of ways and get that word out. And you know, in the past, we've advised people that, well, just leave that LLC in case you want it again, or just leave that S corporation. Let's not dissolve it. The time and trouble to do that is not worth it. You might want to use that again down the road for some other enterprise. We really need to re-look at that. You know, we didn't know what the rules are, and we didn't realize that the net was going to be cast out so wide. But it's scary, and I want to scare you into into talking to your CPA, talking to us. This can be a big problem for the least suspecting business owners.
And as of end of December, they are still finalizing regulations. We have started a process of registering companies. We've done the first half dozen. So the forms are finished, and at this point, we're moving forward with it. But this is going to be a little bit of an evolving area. And one of the things that we're going to be doing for our clients is trying to find out if you actually have to do it. There are 23 exemptions or ways to exempt out. And of course, doesn't apply to everybody. They're going after the small business people. That's clearly who's targeted. The big business people who are more regulated are not going to have to comply with this, but they are absolutely going after the mom and pop shops. Okay, 2024 is a big year for Appleby Healy. This is our 100th anniversary. So 100 years of being in the Ozarks, local lawyers helping local people. David, can you tell us a little bit more about the history of Appleby Healy?
Sure. Well, there were gentlemen on the square in Ozark that had a law practice. Two of them, they both became judges. And in 1923, they were both gone on the bench. One decided he didn't like being a judge, and his son had graduated from law school. So in 1924, they reformed the practice. When I tell people that now we've been around 100 years, some clients, of course, have asked, have I been here all 100 years? I hope they're teasing. But I have been here. I'm in year 49. The first family member to actually come to the law firm was Joe Crane in 1938. My father came in 1951, and I came first working day in 1975. So we have been here a long time. We're proud of that record. We understand that we're about the 15th oldest business still operating in Christian County, Missouri, and we're certainly one of the longest term law firms all over Southwest Missouri. And we're proud of that, and we appreciate all your support in that, and we hope that we've treated you fairly and sent our bills in an amount that you deem to be fair, and have done all the things that would continue to garner your support. And so thank you for 100 years.
All right, thanks for the brief history of the law firm, David. 100 years. It's quite the accomplishment. It means stability for our clients, and we're really proud of the fact of the people who came before us, the legacy that we bear going forward. Obviously, me and Brian are the next generation here, and we have a lot to live up to, and we're confident we can handle it. This wraps up the 2024 Appleby Healy Client Care Program Workshop. If you come out in person, we'd love to see you. The material will be the same, but bring your questions. We'd like to see you. Come on out and give us a call if we can be of any help.